Harold, let's talk about SMH, the chip sector ETF. It's been able to find support at the 21-day line recently. Talk to us about an option trade idea for SMH that you have for us.
Yeah, so this is somewhat of a contrarian play. Chips have done well, and they're still doing. Nvidia's up today. So my reasoning behind the trade is, nothing's going to go up forever. I expect to see some type of pullback. So that's the reasoning behind this bearish play on SMH. So um, we'll get into it. So let
Yeah,
me
let's do it.
share
So
my screen here.
Harold's going to share his screen so we can take a look at the option chain. And we do have the font size blown up a little bit, but
Yeah,
we
so
want
thank
everyone's,
you to there was a couple of IBD Live
yeah,
subscribers who gave me the instructions, so hopefully it'll work
yes.
out there. So,
And also, before you get into this, so a bearish trade. So we've got a bear call spread. This is a credit spread. So first, talk to us about why you like credit spreads, because you tend to go with those, whether it's a bull
yeah,
put spread or a bear call spread. You like getting that premium.
right. I like that premium. I like defined risk trades, so you know what you know exactly what your risk is, and I like that aspect of it. So I tend to stick with these spread trades, and I very rarely go off of that. I think there's just a lot of what I call merchandise out there where you can apply these type of spreads on.
Great. Okay, well, let's get into it.
All right, so we're going to look at SMH. It's a bear call spread. This is a bearish play on technology, basically. So I'm going to start out. I've got SMH here. I'm going to go out to the August 18th, which is 44 days to expiration. So I click on that, and then let me scroll down very quickly. Should have reduced the number of strikes, but here we are. All right. So what I'm going to be doing here, so we got calls on the left side, puts on the right, but we're going to be doing the call spread, bear call spread. So I'm going to start out by selling the 160 strike. So click on that. So I'm selling that, and then I'm going to buy the 165 for my protection. So this is where we get the defined risk aspect of this trade here. So I buy that. So here we have a $5 wide, and it's a credit of 129. So my credit is improved. So let me change this to match the numbers I've got on the left side here. So got those numbers there. So let's take a look at the numbers. I click on call firm and send. And first thing I like to look at is my break even. So my break even is at 161 here. So this stock could go up and still not work against me. It's trading at around 152, 153, and we've got some room to the upside there. So I like that aspect of it. So let's look at the numbers. We're going to look at the probability of success, return on risk, and how many contracts we're going to purchase with this trade here. So let me click on that. And then on the left side here, I have some notes. And first thing we're going to do is we're going to calculate our probability of success. So to do so, I just take the width of the spread, which is $5. We know that the difference between our strikes here. So $5 and our credit received, which is $1.21. And that's going to give us a risk. So our actual risk is $3.79, or in option speak, you got to multiply by 100. So $379 is our actual risk in this trade. Now, to determine our probabilities of success, what we do is we take our actual risk, which is $379, divided by the width of the spread, which is again $5, and that gives us a probability of success of 75.8%. So a good probability of success. Now, our return on risk, what kind of return can we expect on this trade or hope to expect with this trade? So to calculate that, we take our credit received, which is that $1.21, you see that here, divided by our actual risk, and that's going to give us about a 31.9% or close to 32% uh, of return on risk. And that's not bad during a 44-day period. Now, based on these numbers, how many contracts are we going to buy? So we decided that, okay, we're going to put $2,500 of our portfolio into this trade to do. So we take the $2,500. That's the amount of money we want to put into this trade divided by our actual risk. That's going to give us 6 contracts. So take the numbers here, and I'm gonna. Oops. It gives a 6 there. I go down here to confirm and send, and you can see our buying power. So it's not going to be exactly the 2,500. I could change the number of contracts if I want to erase that, but I'm going to leave it as is. There's our max profit, our max loss, and I'm going to send this trade off here. I'm going to send, and then hopefully get filled here. So that's my contrarian look on the technology sector in the market.